All right, let's get right into it and talk about KKR Capital Corp, ticker FSK. We're breaking down their third quarter earnings call, and let me tell you, this was a really important one. The market was watching this company like a hawk, so what they had to say really mattered.
So here's the game plan for this breakdown. We'll start with the headline numbers and how the street reacted. Then we're going to pop the hood and look at the portfolio's health. After that, we'll get into their huge dividend announcement, put it all in perspective against the market, and finally, give you our take with the next call.
Okay, first up, the scorecard. How did FSK actually do compared to what everyone was expecting? And maybe more importantly, how did investors take the news? When you look at these numbers, it's kind of a mixed bag, right? Revenue was just a tiny bit light, but honestly, nobody really cared about that. The big story here was two other things. First, a really solid beat on GAAP earnings per share. And second, and this is the crucial one, their net investment income, or NII, landed exactly where Wall Street thought it would. In a shaky market, in line is another word for stable, and that's exactly what people wanted to hear. And what was the market's verdict? Well, you can see it right here. A relief rally. The stock popped almost 3%, and it did so on some heavy trading volume. Now, this wasn't a party in the streets, but it was a collective sigh of relief. A clear signal that the results were, frankly, better than feared. So the market breathed a little easier. But the real story is always a bit deeper. What's actually going on inside FSK's investment portfolio? Let's get into the nitty-gritty and talk credit quality. And again, it's a story of good news and not so good news. On the bright side, net asset value nudged up, and they brought their debt down. You love to see that kind of discipline. But, and this is a big but, the problem child is still there, non-accrual loans. These are still hanging around at 5% of the portfolio, and that's a number that's still pretty high. Now, for anyone who needs a quick refresher, what exactly is a non-accrual loan? Well, think of it this way. It's a problem loan. The person who borrowed the money isn't paying it back, so FSK has to stop pretending they're earning interest on it. For a business like this, that number is one of the most important signals of how healthy the portfolio really is. It can keep investors up at night. So management knows this is an issue, and they're trying to get ahead of it. You heard it straight from the CIO, Dan Petersack. He made it very clear that they have a special team that's basically doing triage on these problem loans, trying to fix them or move on so they can put that money to work in loans that actually, pay them back. And speaking of generating income, that leads us perfectly into what was, honestly, the biggest bombshell of the entire call. FSK is completely changing its dividend strategies starting in 2026. This is a big deal.
So what are they actually doing? Well, they're ripping up the old playbook. They're getting rid of that high fixed dividend of 70 cents. Let's be honest, they were struggling to cover it. Instead, they're hitting the reset button. The new base dividend will be a much more manageable 45 cents. Anything they earn above that will get paid out as a variable or supplemental dividend. The goal here is flexibility and sustainability.
And if you're wondering why they had to do this chart just says it all. Look at their earnings, what they were actually making. It was around 57 cents per share. I mean, you can't pay out 70 cents when you're only making 57, right? The math just doesn't work. This new 45-cent base gives them a ton of breathing room. It de-risks the entire story.
Okay, so we've got a stable quarter and a de-risked dividend. In a vacuum, that sounds pretty good. But how does it look when you zoom out and compare FSK to its peers? Because context, well, it's everything.
And yeah, this is where the picture gets a little painful. Year to date, FSK is down a whopping 28%. Now, the whole sector is down sure, but only by about 7%. That's a huge gap. It really puts this good quarter into perspective. This wasn't a victory lap. This was them stopping the bleeding after a really, really tough year. But even with that ugly performance, management is doing everything they can to signal to the market, hey, we've got this. You can kind of see the trail of breadcrumbs they're leaving. They raised new debt to strengthen their finances, they delivered these stable results, and then, just a few days later, the CEO himself went out and bought 10,000 shares with his own money. It's a classic skin-in-the-game move.
All right, let's land the plane here. We've looked at the numbers, the dividend, the context, so what does it all mean for investors? This is our take. This is the next call.
And this is really the million-dollar question, isn't it? What do you do with FSK right now? You've got this tug of war happening. On one side, the stock looks cheap compared to its assets, and the dividend seems safe now. But on the other, you've got that nagging credit quality issue that just won't go away. So what's the move?
Here's how we see it, broken down into 3 simple steps. 1, the ship has been steadied. Resetting that dividend was painful, but it was absolutely the right call. It takes the biggest risk right off the table. 2, the game has changed. It's not about survival anymore. It's about execution. All eyes are now on that non-accrual number. Can they finally bring it down? And that leads to our third point. We think the stock is kind of stuck in neutral for now. It's probably not going to fall off a cliff, but it's not going to rocket higher either. Not until we see real proof that the cleanup job is working.
And all of that brings us to our final rating, market perform. Look, they've done the hard work of stopping the bleeding and stabilizing the company. The dividend's in a much safer place. But stable isn't the same as great. To really outperform, they have to prove they can fix those underlying credit problems. Until we see that proof, we just expect the stock to perform right in line with the rest of the sector.
And of course, before we go, we have to wrap up with the usual disclaimer.
Just a quick reminder, everyone. Nothing you've heard here today is intended as financial advice. We're just breaking down publicly available information. Always make sure you do your own homework before making any investment decisions.